Hey there, folks. Welcome to the Profit Logic YouTube channel. My name is Andrew Bloom. I am a bookkeeper and an accountant, and I help small businesses of all kinds across the United States with their monthly bookkeeping and getting their financial statements in order. I'm also a PhD student in business with a concentration in accounting. And today I'm taking the six-figure value of my accounting education and turning it into the simplest, most entertaining crash course in accounting that you'll ever watch. By the end of this video, you're going to learn the basic accounting principles and terminology that power every single financial decision in your business. And this is also the underlying framework of the accounting software you are likely going to be using, such as QuickBooks or Wave, when you're doing your own business's books. And we're doing it through a story that makes everything finally just click. Because humans remember stories much more easily than they remember any kind of rant on a theory through a lecture. Think about it. I'm sure you remember the final episode of Game of Thrones much more readily than you remember the facts from a lecture about the Battle of Gettysburg, for instance. So we're here talking about accounting, the language of business. And we're going to make it simple, intuitive, and hopefully genuinely enjoyable to learn. So if you ever open QuickBooks or try to look at financial reports and thought to yourself, I'm a business owner, I should understand this, but it's so darn confusing, then you're in the right place. By the end of this video series, you're going to understand the core mechanics behind every business's financial system. You're going to learn the meaning of a number of common business terms such as assets, liabilities, equity, expenses, revenue, profit, and so much more. Everything you would need to grasp at least the first semester of an accounting course. This means you'll be able to read your business's financial reports, and you'll be able to speak the same language as the potential investors in your business and banks who could also help you with things like a loan and other ways to fund your business. And we're going to do it with a fun story about three kids who accidentally create a thriving business one summer. Through their decisions and actions, you're going to see accounting come alive in a way that's memorable, visual, and very easy to follow. And if you want to be able to access this series in the future or come back to it at a later time, if you start one and want to finish another video later, be sure to subscribe to this channel, save this playlist, and let me know you like it by giving it a thumbs up. All right, take a breath, settle in, and let's step into the world of the Fix-It friends. Imagine going back in time with me just for one moment. It's the last day of school. The classroom clock is ticking louder than usual. The windows are open. Sunlight spills across your desk in long, warm stripes. Outside, you can hear the lawnmowers, a passing truck, distant shouts from kids who got out early. Your backpack is already zipped. Your pencil has retired. You're not thinking about homework or tests anymore. You're thinking about summer. The bell finally rings. You and your two best friends, Jordan and Sam, explode out the door. You're laughing, biking, rubber slapping the sidewalk. No homework, no schedules, just sun, bikes, and snacks. You head back to your neighborhood. Sprinklers tick, tick, tick in front yards. The air smells like hot pavement and fresh cut grass. For a moment, life is simple. And then you notice something. Mrs. Thompson's fence is peeling. The Johnsons' lawn looks like a jungle. The Wilsons' trash cans are still at the curb from like 3 days ago. You, Jordan, and Sam, y'all look at each other. And this tiny thought bubbles into your mind. People would probably pay us to fix this. Pause with that, because this is the moment when a kid with free time becomes a kid with a business. You decide this summer you're not just going to ask for money. You're going to earn it. You grab a notebook, you grab a marker, and you write the name Fix-It Friends. Lawn mowing, fence painting, yard cleanups, anything your neighbors don't want to touch. Nice and simple. Real work, real money. And today we're going to use the story of the Fix-It Friends to teach you the equivalent of a semester's worth of accounting without making your brain melt and your stress increase tenfold. So ready? Take a breath. Let's turn this into your first accounting lesson. So every real business needs a safe place to keep money and a clear way to keep score. You find an old shoebox. You tape it shut, cut a little slot in the top, and write in big dramatic letters, Fix It Friends, Money Box, Private, Keep Out. Is this legally binding? Nah. Does it feel official? Absolutely. Now question. Right now, how much money is in the box? 0. So you and your friends decide to chip in a little money. Jordan puts in $10, Sam puts in $10, and you put in $10. Let's pause and track that slowly. We'll draw a big T-chart, our first accounting scorecard. Left side, write what we have, and right side, write who owns it. Now fill it in together. On the left, we have cash, $30, and on the right, we have owner investment, which is Jordan, Sam, and you, also equal $30. Now I want you to say this aloud, even if you're alone. What we have equals who owns it. So is it true here? Left side, we have the $30 cash. Right side, we have $30 from the owners. They match. Good. So let's give this its own grown-up name. On the left side, what we have, this is called assets. Think the things and stuff that a business owns and controls. And on the right side, who owns it, is split into 2 groups. One is liabilities, people we owe money to, and right now we don't owe money to anyone. And secondly is owner's equity, what the owners are entitled to. And right now, these 3 are entitled to the $30 cash they have in their box. So we can rewrite our rule to assets equals liabilities plus equity. This is the magic equation, the absolute foundation of accounting. It is called the accounting equation, and it is the most important rule underlying all double entry accounting systems and most accounting softwares such as QuickBooks. So say it again with me. Assets equals liabilities plus equity. Tattoo it on your forehead, or your partner's forehead who you're doing business with, and you'll look at them more often than you'll be looking in the mirror. Now, pause and notice something important. This little chart we made, this is a single moment. Right now, in this exact moment, it shows how much the business has and who has a claim on it. This is a snapshot. And in grown-up terms, we call that a balance sheet. Why is it a balance? Because the left side of the equation always needs to equal the right side. If the sides don't match an amount, then something is wrong. Either you missed a transaction, someone miscounted, you lied to yourself, I don't know, but something is off if it doesn't balance. So I'll repeat it for memory's sake. This chart is a snapshot of a moment in time. It shows assets, liabilities, and equity, and it must always balance. All right, let's move forward. Now we hit our first real life decision. The kids find a lawnmower at a garage sale. It's not pretty, but it does work. And the price tag on it is $50. Do you and your friends have $50? Let's look at the scorecard again. Cash says $30. So what are their options if they don't have the money on them? Give up on the idea, wait and save, or find someone who's willing to give a loan. Luckily for the Fix-It Friends, Jordan's mom is willing to loan them $25. She says to them, I'll loan you $25 so you can buy the lawnmower, but it's a loan. I want that money back. Now this is important. She said loan. She didn't say gift. So what happens on our scorecard? First, does the business get more cash? Yeah, it does. Cash goes from $30 to $55. So we'll update the left side. Under assets, Cash now shows $55. And we ask ourselves, who has a claim on that $55? The three of you still have $30 in ownership that you contributed, but now Jordan's mom is owed $25. She has claim to it. So on the right side, under liabilities and equity, the loan from mom, we have $25. And the owner investment, our equity, we have $30 for a total of $55. Let's check the equation again. Assets, $55. Liabilities and equity, $25 plus $30, also $50. Perfectly balanced. Now let's slow this down real quick while it's still simple and repeat it because it's really important. Do you own that $25 from mom? No. You control it and you can decide where you want to put it, but you must pay it back. That's why it's not equity. And what do we call money that we must pay back? That's a liability. It's fancier language, and in other terms, it's also called a note payable or a loan payable. But the $30 from you and your friends, do you owe that back? No, that's your investment in your own business. It's owner's equity. So now, for the very first time, your grown-up equation is alive. Assets equals liabilities plus equity. 55 equals 25 plus 30. This is the exact same math that would apply to a contractor getting a loan from the bank, a real estate investor with a mortgage, or an online business owner with a credit card balance. Same structure, totally different numbers. Let that sink in. So now the kids hand over the $50 and they buy the lawnmower. Let's look at what happens here. When you buy the mower, does your cash change? Yes, it does. Does your total stuff that you own change? Yes, that does too. Let's see how that works. So you pay $30 from your owner money and $20 from mom's loan for the $50 for the lawnmower. Physically, it's just $50, but we know where it came from. 30 from equity, 20 from the loan. So after paying, the amount of cash in the bank goes down from $55 to $5. But now you own a mower. Is the lawnmower a useful piece of equipment that you're going to use for a long time? Yeah, it is. Is it something that the business controls? Yes, that's true as well. Then that's when we declare it an asset. So let's update the scorecard. Under assets, our cash is now down to $5. Our equipment, an asset, the mower, is worth $50. So for total assets, $55. And let's look on the other side of the equation. Liabilities plus equity, we got a loan from mom for $25 and owner investment for $30 for a total of $55. Completely balanced. Look at that. Did buying the mower make you more poor? At first glance, some folks might think we lost $50. We just bought a lawnmower. But look again. Before buying, you had $55 in cash. After buying, you have $50 in a mower and $5 in cash. You didn't lose value. You changed the form of that value. Trading one asset, cash, for another asset, equipment, does not hit your profit. This is the difference between spending on something that is gone pretty much immediately, such as with an expense, versus investing in something that's going to stay and stick around to help the business grow value over time, which is an asset to be capitalized. So let's introduce a grown-up rule. When you buy something big, useful, and long-lasting for your business, that is an asset. You capitalize it. You do not record it as an expense. This is how contractors note their tools and their equipment, how real estate investors handle buildings and refurbishments, and even small businesses taking on equipment like a nice brand new computer and acquiring it as an asset. So again, if you think that it's a big long-term benefit, it's probably an asset. or if it's something more short-term and going to be used up soon, then it's probably an expense. Your Fix-It friends just made their first capital investment. Next, you realize that the mower needs gas. You also want flyers to pass around the neighborhood. So you spend $3 on gas, $2 on flyers, for a total of $5. Let's go over this. Before expenses, we had $5 in cash, a $50 mower for a total of $55 in assets. For liabilities, we have a $25 loan from mom, and in equity, we have $30 owner investment for a total of $55. We're aligned and we're balanced. Now we've spent $5 on gas and flyers. So let's ask ourselves, do gas and flyers last a long time? No. Will they be used up fairly soon in the business? Yes, they will. So are they assets or expenses? In this case, they're most likely going to be expenses. So let's update our scorecard. We got cash going from $5 down to $0. Our equipment is still a $50 mower, and the assets now are $0 cash plus $50 equipment for a total of $50. And on the right side, it still shows a loan of $25 and owner investment of $30 for a total of $55. But 50 doesn't equal 55. It always have to balance, remember? Something's wrong here. Where did the missing $5 go? It didn't vanish, but it did become the cost of doing business. And we call that an expense. Expenses are going to reduce what the business is worth to its owners. Expenses reduce earnings, and earnings live under equity. So now we adjust the right side. Liabilities plus equity. We got the $25 loan from mom, an owner investment of $30, and earnings to date, a expense of $5, so a $5 loss. The total now is 25 plus 30 minus 5, which equals 50. Now we're back in balance. We spent $5 on supplies, which reduced our cash by $5, and also reduced our earnings. So it reduces the equity. This is exactly how things like advertising, software is handled for businesses under expenses. This is exactly how things like advertising and software fees are used up as expenses in businesses. So keep in mind, expenses do not live on the balance sheet. They live on another statement called the profit and loss statement. When the business gets income, also known as earnings, expenses reduce those earnings, which also reduces equity. So we keep another report card called the profit and loss statement, also known as the income statement, to track the expenses and the income coming through the business. So here's a first glance of our income statement. For sales, so far $0. We have $5 in expenses for a net profit, also known as the bottom line, of negative $5. And that sitting right there is the earnings to date, which feeds into equity. Pretty clean. It's a structured system. Now the fun stuff. The Fix-It friends hang up their flyers, the neighbors call, and this weekend you end up mowing 4 lawns at $10 each. You work hard, you sweat, you smell like gas and grass and victory. So at the end of that long day, you count 4 lawns times $10 equals $40 cash. Cash was 0 before, and now we add in $40 for a total of $40 in cash. There were no new loans, no new investments, no big assets, just earned money. So let's update. We got assets, $40 in cash, $50 in equipment as a lawnmower, for a total of $90 in assets. For liabilities and equity, we have a loan of $25, plus owner investment of $30, and our earnings to date, it was a negative $5, but now we add in the $40 we earned. So a negative $5 plus 40 leaves us with $35. Total for the right side, we got 25 plus 30 plus 35 equals 90. It is a balanced scorecard. When we're talking about profits and expenses, earnings and expenses, we're really talking about profit and loss, which is also known as the income statement. So for our very first income statement that is covering this work period this week, it looks like this. We made $40 in sales through mowing. We had $5 in expenses through gas and flyers for a net profit of $35. This net profit is also known, again, as the bottom line. You're going to hear that term thrown around in business all the time, especially with investors. And that $35 is not floating in space. It flows from the income statement into the balance sheet, into equity. And that story of money moving is a part of what's known as cash flows. We're not going to go too deep into that right now, but we will in later lessons. The money that has flowed through the business looks like this. We got $30 from owners, $25 loan from mom. We spent $50 on a mower. Another $5 were spent on expenses. We made $40 in revenue. Now notice, profit is $40, but the cash in the bank is $35. Are those two the same number? No, they're not. And why is that? Because that cash is a mix of owner investment, loans, and revenue, but also expenses. This is important to note that profit is not the same as cash. And cash can only tell you how much money is in the bank. It is not going to show you how well your business is actually doing. So you've just seen in the kid world the same kinds of business transactions that occur in the real world. And it's the same mechanics that run things like construction firms, real estate investments, small businesses, online agencies, you name it. It's the same equation, same kind of flow, but usually with a lot more commas in the numbers. So in this first chapter with Fix-It Friends, you already learned some pretty powerful accounting fundamentals without even realizing it. You learn to track what we have and who owns it, and how those two sides, the assets and the liabilities and equity, how they come together to create the balance sheet. And you know now that the accounting equation, assets equals liabilities plus equity, must always balance. You discover the difference between capitalizing a long-term asset like a lawnmower, which will stay useful for a long time, and expensing a short-term expense, items such as gas and flyers, which get used up right away. You also saw how expenses can reduce earnings and how these expenses and earnings live inside the equity section of the balance sheet. Then Fix-It Friends earned their first $40, and you watched how sales minus expenses creates the bottom line, also known as profit or net earnings. And you saw how that profit flowed into the balance sheet as well, also a part of equity. And also you learned a very important but sometimes misremembered fundamental of business, that cash does not always mean profit, and profit doesn't always mean cash. Profit is not the same as cash. A business can be profitable and still have low cash, or it can have plenty of cash but be losing money in liabilities, which is why every single business owner needs to pay attention to both. This simple story just taught you the core mechanics behind accounting, and now we're ready to build on it. In the next lesson, the Fix-It Friends are going to level up. They won't just be trading time for money. They're going to add in a new form of a product or a service. They're going to renovate their old clubhouse and turn it into a rental space and add in some other products to the mix. This is where we're going to be talking about topics like inventory, rental income, cost of goods sold, and how to keep using these same simple scorecards that you just mastered. I'll see you in the next video.